And welcome. You are listening to Watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, we got an amazing jobs number last week, but was it really that amazing? Are the books cooked? Are they telling us the truth? Well, our good friend David M. Stryzewski is with us now. David, welcome back. So, what about these job numbers? Are they showing reality, or are they just a political creation like everything else?
Well, great to be with you here, Kerry. So, yeah, the January jobs report if it sounds too good to be true, it's probably because it is. The U.S. Bureau of Labor Statistics on Friday came out with this 517 positive amount of new jobs that were just added. Here's the thing that we're not as aware of if we don't understand these reports and how they're created. And so in January here, they added 2.5 million. Without the seasonal adjustments, in January, we were 2.5 million actually short of what we had here in December, which is incredible. So we've got this idea of the seasonal adjustments, which is supposed to smooth things out. But this BLS report ends up adding an additional 3 million jobs in order to come up with this figure. So these are, out of nowhere jobs that they do based upon some specific ideas that they call seasonal ideas. And so if we look at November and December, though, they actually subtracted 2.14 million in order to come up with those numbers. So I think it's better to ignore this report altogether than to put a tremendous amount of weight in it. Of course, we saw the market, though, kind of respond to the Fed last week, thinking they were going to be a little bit more dovish. And then on Friday, we got this report, and then they said, oh, my goodness, this is worse than what we thought. They're going to be, at this for longer. And so we find ourselves in a very interesting time right now, as I really think that there's three primary opinions on what's going on in our economy. So opinion number one is what the Fed thinks. Opinion number two is what the markets think. And then opinion number three should be what reality ultimately says. And this really comes down to this idea of what the terminal rate is. So that the Federal Reserve is raising interest rates, and they're hoping to get to this magic place that they don't even know where it is, that's called a terminal rate. And when they get there, then it's expected that inflation is just going to go down automatically and not just because of these rapid increases like we've seen. And so the market believes that we've already hit our terminal rate. And so what they're expecting the Fed to do is to pause in these rate increases and then pivot to a lower and reducing terminal rate over the next 12 months. And so, I probably agree with the market, specifically the bond market, that we likely have gotten to a terminal rate, or a place where I think it makes sense to pause and begin to understand, hey, where are we at? Have we gotten to this place? Are things coming down naturally? Or are they coming down because of this, very, very, very significant increase that we've seen by the Fed? The Fed is ultimately saying, hey, we're going to be higher for longer. And so I think that they're, probably tightening into a recession right now, which should be a concern to people today, because if they begin to pivot and we're already in a recession and we find ourselves in a bad economic position, well, guess what? I don't know that there's much that the Fed can do to swiftly change things. So I think of the good history lesson here is that if we look back at the late 70s and what had to happen with Paul Volcker, he hesitated on the interest rates, started pulling back, and then saw inflation take off again, and then had to really ramp things up. In 2018, the Federal Reserve was raising the terminal rate, and then what happened is we saw that almost 20% downturn, like 19.9, I think it was, in the Nasdaq. I believe it was February, and so then the Fed just quickly accommodated and brought us down to these record low interest rates, which of course, got our economy, in my opinion, way overheated as we headed into this time frame where inflation was absolutely ramping up, and it was not transitory as they thought. So I think the reality of where we're going next is somewhere in between what the Fed thinks and what the market actually believes. So I think they're probably going to see a couple of rate hikes from here, a quarter point higher. We're looking at some unemployment happening in the tech sector, but we all know that the tech sector was overvalued. We all know that the tech sector had way too much money. Every VC deal got done. Every IPO got established. And so, if we look at just even the lifestyle of these employees, that were at Twitter and Facebook and Google, and just the amazing, accommodations that they had, that's not likely as real, kind of as we look at the world here today. But as far as unemployment goes, I think small and medium sized companies are still hiring. I think that there's proof that that's within that. It's just that they're going to be hiring at a lower price than what the big tech companies were paying previously. So I think there's a big revaluation coming from this work from home reality. And work from home is still wonderful, and employees are still needed, but we're going to find ourselves in a tighter economy right now, and so this opens up, I think, opportunities for the small and mid-sized companies, as there is some unemployment. But look at that, 2.5 million jobs less than what they're actually saying, from December. So I'm not convinced that we really have a good fact set to be working from. And, ultimately statistics can lie here. So it's anyone's guess.
Hey, it's anybody's guess. Maybe the purpose of these numbers, besides painting a brighter picture, if you will, maybe what they're really about is just giving the Fed some elbow room to get in a couple more increases before they inevitably have to pivot, and they're going to. I don't think there's any question about that. But now it looks pretty good.
Well, it sure does, at least in the short term. And we like to look at the world in 3 different time frames. Just like the watch on my hand has an hour hand, a minute hand, and a second hand. Those are 3 different time frames throughout our day. Neither one of are telling the time exactly right or wrong. They're just telling it exactly the way that it should be for where we are in a minute, an hour, or the day. And so right now, in the short to midterm, we are seeing some positive things that are moving forward. And so, is this a bear bounce or a dead cat bounce, a bull trap, as it's also called? In my opinion, it likely is looking like that, as opposed to this being a new cyclical bull indicator. And the reason why I can say that is that, there are 5 indicators that we can track that are either never wrong or rarely wrong, that are all flashing warning signs today. And so the first one with that is to look at the inversion that's taking place right now in the yield curve. And so this is where we get this idea of, what do the markets think? So the markets think that there's going to be, a transition that's going to be taking place here sometime this year. And so that they tell that between the difference between the short-term rates being a lot more money for the investment than a longer-term rate, like even the 10-year Treasury. So if you even look at the 1 month term right now to the 10-year Treasury, it is much higher than that we actually even saw in 2008 or the .com. And so that's really important, I think, for us to understand here, because this inversion has been an incredibly accurate indicator of where we are, and it's getting closer and closer as we're now at the 1 month time frame as opposed to just the 2-year. We've got falling PMIs, and so this is when we look at those who produce and manufacture. This is the wholesale. This is activity that's taking place. If we fall below 50, that means that we're in a contractionary market. If we expand beyond 50, that means we're in an expansionary market. Well, right now, the United States is at 47.7. We got a reading last week. And, I also looked up what other nations are being tracked by this PMI indicator. And very, very interestingly, whether these 40-year nation, or sorry, all 40 of these nations, they're either below 50 or just at 50 right now. So to see a recession is one thing, but a global recession all taking place at one time, this ISM indicator is rarely ever wrong, and it is literally flashing red every single place that we go. So again, I vote the market goes up forever, and that may work for the short term, but we also need to be a little bit cautious here about where we find ourselves, because this is a big deal. Number 3 is the quantitative tightening cycle that we're in. So we did quantitative easing, which made it easier to get loans and to just make that a lot more prevalent. Well, now they're still having to run off the balance sheet, and they're doing so at about $90 billion monthly. So a little over $1 trillion per year. This is a very big deal because the Treasury balance sheet has ballooned out of control since 2008. Also to note with 2008, a tightening of quantitative measures has never actually been done. And it was literally the opposite approach of what we had in 2008. So a lot of what got us out of 2008 was that we just loosened and we reduced rates, we loosened up the lending, and the economy got booming again, specifically in the housing market. And that right now is a significant challenge, which leads me to my fourth point, which is that the softening right now in the home building. And so, real estate's a lagging indicator. It never leads, it lags. Why? Because permits take months or years to take place. But also we can understand that it's more costly today for a contractor to have employees, to have acquired the land, to get supplies. We've got delays associated with this. But more importantly, the buyer is unable to purchase at the same price that it had the ability to when interest rates are at 3%. So 30-year rate right now is over 6%. And that's if you don't have PMI insurance, so having 20% down. That's a really big deal because essentially borrowing has doubled. And so I'd say it's a buyer's market right now for real estate, but where are the buyers today? At least on a national scale. Down in Florida where you're at, there's still some appetite because people are trying to get out of higher tax places. They're potentially trying to get out of weather cycles that they're not as fond of, but we're seeing the home building softening right now in a very significant way. And then the fifth one is the U.S. consumer. And so as we understand the United States economy, 70% of it is based upon the consumer's buying and spending power. Well, the consumer has had 2 full years now of significant inflation increases. And though we are seeing inflation coming down and the Federal Reserve has, given us that thumbs up that they're seeing the beginning of that occurring, that just means that we're going to have lower inflation for longer. It doesn't mean, though, that the higher prices that we see today and we're paying at the grocery store are going to go away or revert back to where they were. So the U.S. consumer, my personal opinion, has not been prepared for the cycle that we find ourselves in today. The White House hasn't been preparing them. And in fact, they're saying, hey, there's no recession. They've been telling us there's a recession coming the whole time, and it's never happened. We're stronger today than we ever have been. Well, that's pretty crazy talk as far as I'm concerned. But the U.S. consumer is being hurt significantly. You can see spending rates going down. We can see saving rates going down. But more importantly, credit cards are going up. And let's just be honest here. No one is putting, balances on a credit card because that was a good idea. I mean, 20% plus on interest rates is crazy, but we're being forced to do it. But, the average consumer is kind of running their family budget, kind of like the Congress has been running our national deficit. So we find ourselves with a new deficit ceiling conversation coming up here. And again, I do not believe this has been modeled well for us. And I think that my worst case scenario is kind of coming true as I guess we're going to be seeing these numbers unfold here over the next few months.
All right. So the reality is going to assert itself. There's nothing the Fed can do, or the BLS, or the federal government. They can put out rosy scenarios, rosy predictions, but the economy certainly looks like it's headed for a tailspin, not to mention the inverted yield curve, which has an uncanny ability to predict these recessions.
That's right. And Kerry, just even to the point, when we see the pause from rising more interest rates because they think they got to the terminal rate, and then they see a pivot to reduce rates, very, very important for people to understand that the average downturn after a pause and pivot occur, the average downturn is 35.5% over the next 15 months. And so again, I'm not coming up with these, this is just factual as far as how other cycles have performed in the past. And so to say this time it's different, well, I'd say that those are pretty different words than we should be looking at right now because that's pretty dangerous. So, it's a daily beauty contest out there. I mean, I vote things turn around, they work out, but I'm just not seeing the supply side economics that it's going to take. We're curbing demand. We're not fixing supply. If we were lowering taxes, if we were, drilling and doing more exploration here for oil at home, if we hadn't canceled the Keystone Pipeline, if we weren't seeing, the jobs and wages and the challenges that are just starting to come to light, and hopefully the statistics will start to reveal a little bit more clearly, I'd say that you know, that we're on our way to a better time frame. But it just seems to me like things are just slipping further and further, and this is going to get beyond the Fed's reach here without too much time.
All right. Well, we really appreciate you coming on, David. We want to contact you through the web, connect with you. How do you do that?
Sure. People can go to our website, myspg.com. And I've actually got educational classes that are going to be going on here in things like Social Security, taxes, principal retirement planning, investing in the 21st century, teaching people how to ride bulls and tame bears, which is, you know, how to take advantage of the opportunities when they're here and avoid the pain and the challenges when they're not. And so we've got a you know, methodology and way in which we do this, a proprietary process that helps us to evaluate these timeframes and capitalize on times like now. So, you know, the market cycles are likely going to be very different over the next decade than what they have been leading to this part of the decade. And so the question is, how are we prepared to transition into this new economy post 2020? So the 21st century is not for the faint of heart, especially for those nearing and entering retirement.
Couldn't agree with you more, David. Thanks for coming on. If you've got a question for David or myself, the email is kl@kerrylutz.com. Please write your questions below on the YouTube channel and go over to the site, financialsurvivalnetwork.com. Make sure you sign up for your free newsletter. David, a pleasure. Thanks for stopping by.
Hey, appreciate you, Kerry. Thank you. Talk to you soon.